Wishes to all of you. Welcome, students, for a new topic: role of monetary development. So, monetary policy is the policy adopted by the monetary authority of a nation to affect monetary and other financial conditions to accomplish broader objectives like high employment and price stability. So, monetary policy plays a crucial role in an economy's overall health and growth. By managing the money supply and influencing interest rates, central bank can steer the economy towards stable prices, full employment, and sustainable development. Objectives of monetary policy. There are three main objectives. The first one is to maintain price stability. Second one is economic growth, and third one is financial stability. So price stability is one of the policy objective of monetary policy is to stabilize the price level. Both economists and laymen favor this policy because fluctuations in prices bring uncertainty and instability to the economy. Rising and falling prices are both bad because they bring unnecessary loss to some and undue advantages to others. So the policy of price stability keeps the value of money stable, eliminates cyclical fluctuations, bring economic stability, helps in reducing inequalities in income and wealth, secures social justice and promote economic welfare. The second one is economic growth, promoting economic expansion, employment and rising standard of living. So, one of the most important objectives of monetary policy in recent years has been the rapid economic growth of an economy. Economic growth is defined as the process whereby the real per capita income of a country increases over a long period of time. So, economic growth is measured by the increase in the amount of goods and services produced in a country. A growing economy produces more goods and services in each successive time period. Thus, growth occurs when an economy's productive capacity increases, which in turn is used to produce more goods and services. The third one is financial stability, ensuring the smooth functioning of the financial system and mitigating systematic risk. So another important objective since 1950s have been to maintain equilibrium in the balance of payment. The achievement of this goal has been necessitate phenomenal growth in the world trade as against the growth of international liquidity. It also recognizes the deficit in the balance of payment will retard an attainment of other objectives. This is because a deficit in the balance of payment leads to a seizable outflow of gold. Then targets and indicators. The primary target include inflation rate, unemployment rate and exchange rate. The indicators, key indicators monitored by policymakers include money supply, interest rate and credit growth. Then the data sources, central bank rely on economic data from government statistical agencies and private sector services. Instruments of monetary policy, interest rate, open market operation and reserve requirements. Adjusting key interest rate to influence market rate and credit conditions. Then open market operation, buying and selling government securities to expand or contract the money supply. Then the reserve requirements, changing the amount of reserve bank must hold affecting their lending capacity. There are two types of monetary policy. One is expansionary monetary policy, another one is contractory monetary policy. So through lowering the rate of interest, increasing money supply and reducing reserve requirements, the monetary authorities can expand the money supply and by lowering interest rate means reducing key interest rate to stimulate borrowing and investment. Then increasing money supply by buying government securities to inject more cash into the economy. Then reducing reserve requirements, allowing banks to lend more by holding fewer required reserves. So through this measures, they can expand the monetary policy. Then contractory monetary policy is just opposite, raising the interest rate. In order to reduce, they raise the interest rate and discourage borrowing and spending. Then second one is decreasing money supply. So in order to buy the government securities, they sell the government securities to remove cash from circulation. Then increasing reserve requirement, required banks to hold more reserves, limiting their lending capacity. Then what are the challenges in implementing monetary policy? There are, in any cases, even though there is more benefits, in case some or unavoidable reasons, there are some challenges in implementing the monetary policy. They are lags in transmission, political pressures, uncertain economic conditions, and globalization effects. So lags in the transmission, in the sense the effect of policy changes take time to materialize, making it difficult to time interventions. Once it's formulated, to execute it takes time. This time lag is a big challenge in the economy. Then uncertain economic conditions. Policymakers must make decisions based on imperfect information and forecast. They may, the policymakers make a policy, but some are the other reasons, some unavoidable reasons or some uncertainties, they are not able to make perfect informations in particular period of time. Then political pressures. Central bank may face conflicting demands from different stakeholders. Then globalization effect. Even though the globalization has a positive effect in international trade, though some spillover effects from other economies can complicate domestic policy decisions. So on the whole, monetary policy is a powerful tool for governments to promote economic stability and growth. Careful calibration of policy instruments is required to balance competing objectives and address economic challenges. Effective communication and coordination with other policymakers is crucial for the successful implementation of monetary policy. Thank you for watching. See you on other video. Thank you.